China's yuan is at a 16-year low, and the country appears to be experiencing deflation. Economists say these are signs China could be facing an extended economic downturn.
Why is China's economy suddenly unraveling? How can a nation once seen as the world's most unstoppable powerhouse now be struggling with slow growth, empty apartments, and rising fear in its own markets? Here's the truth. This isn't speculation. The cracks are already here, spreading deeper each month. Let's uncover how it all began and where it's heading. For 40 years, China was the ultimate success story. Factories boomed, cities expanded at lightning speed, and its economy seemed to leap forward year after year. People called it the Chinese miracle, a model of growth other nations tried to copy. But miracles don't last forever. Beneath the shiny surface, China built an economy dependent on construction, cheap labor, and massive borrowing. For years that formula worked. Now it's breaking down. At first glance, official numbers still look impressive. In 2025, Beijing announced growth above 5%, right on target. On paper, it seems steady, even strong. But step inside the numbers, and the story is very different. Much of that growth came not from households or innovation, but from government stimulus and deflationary effects that distort the picture. Beneath the surface, retail sales slowed to their weakest pace in years. Factory output fell, and youth unemployment hit record highs before officials stopped publishing the data altogether. It's a portrait of a slowing giant, painted over with political gloss. The first major crack is housing. Once the backbone of China's growth, the property sector is collapsing under its weight. Developers like Evergrande and Country Garden are defaulting, and unfinished homes now dot skylines where optimistic families had invested their savings. Walk through many Chinese cities today, and you'll see the evidence. Rows of unfinished towers, silent construction sites, cranes frozen in place. Local governments, which once funded themselves by selling land to developers, are suddenly broke. Their budgets collapsed along with the property market. What was once the backbone of growth is now a dead weight dragging the economy down. Debt is the second crack, and it runs everywhere. Local governments relied on shadowy financial vehicles called LGFVs, local government financing vehicles. They borrowed trillions to fund roads, bridges, stadiums, and industrial parks. Officially, these loans were off the books. In reality, they built up one of the largest piles of hidden debt in the world, estimated between $7 and $11 trillion. Today, many of those loans can't be repaid. The result is a silent crisis. Governments slashing services, delaying payments, and in some cases defaulting. For ordinary people, that means school without new textbooks, hospitals with outdated equipment, and roads left unrepaired. It's not just a debt problem, it's a trust problem. When people see governments unable to pay their bills, they stop believing in the system's strength. And in China, where faith and stability has always been the glue, that's dangerous. The third crack comes from consumers. China has more than 1 billion people, but right now they aren't spending. Prices are falling across the economy, not rising. This is deflation. On the surface, it sounds like a good thing, but in reality, it's deadly for growth. When consumers expect prices to drop, they wait to buy. Why purchase a car today if it'll be cheaper tomorrow? Why invest in a home if values are sliding? The hesitation ripples outward, starving businesses of revenue and slowing the entire system. Factories, once the pride of China, are slowing as well. For decades, China was the world's workshop, producing everything from toys to smartphones. But in 2025, factory activity shrank to 5 consecutive months. That means idle workers, half-empty assembly lines, and export orders drying up. Western companies are diversifying, moving production to Vietnam, India, or Mexico. Tariffs and trade wars are accelerating the shift. For Chinese workers, this means shorter hours, lower pay, and in many cases, sudden unemployment. The financial sector is feeling the pain. Chinese banks, especially the Big Five, are under stress. Defaults are rising, especially on mortgages for unfinished homes, and loans tied to struggling developers. Net interest margins, the profit banks make between lending and borrowing, have collapsed to record lows, barely above 1%. Some banks have even reduced their lending to households and small businesses, fearing losses. Imagine trying to start a small business in this environment. You apply for a loan, but the bank won't approve it. Or you do get the loan, but interest rates eat away your profits before you even open your doors. Without credit, entrepreneurship shrivels. And without entrepreneurship, an economy stagnates. Then comes politics. For years, Beijing fueled growth by loosening restrictions, encouraging entrepreneurship, and attracting foreign capital. But recently, the trend has reversed. Campaigns like Common Prosperity have tightened state control, restricted private wealth, and scared off investors. Major tech firms have been slapped with fines, regulations, or even dismantled. Billionaire entrepreneurship have been sidelined. Their companies reined in. The message is clear. The party comes before profit. But this control comes at a cost. Foreign investment is drying up, private innovation is stalling, and capital flight is rising. Global firms are wary. Venture capital that once flowed into Chinese startups is moving elsewhere, toward India, Southeast Asia, or even Africa. It's not just money leaving, it's confidence, and confidence is harder to restore than capital. Layered over all this is geopolitics. China is locked in an economic tug-of-war with the United States. Tariffs, export bans, and technology restrictions have reshaped global trade. Access to advanced microchips, vital for AI and next-generation tech, has been cut off. That weakens industries China hoped would power its future. A trade war doesn't just mean slower exports. It means isolation from the very technologies that drive modern growth. Meanwhile, other countries are hedging. Japan, India, and Vietnam are building stronger ties with Western economies. Supply chains are diversifying, and China's reputation as a reliable partner has been shaken. Global trade once lifted China higher every year. Now it's pushing back. The deepest challenge, though, is demographic. China is aging faster than almost any country in history. The One China policy, enforced for decades, left the country with fewer young workers and a growing elderly population. By 2050, nearly 40% of China's population will be retired. Already the working age population is shrinking. For the economy, this is a ticking time bomb. Factories face labor shortages, healthcare costs skyrocket, pension systems strain, families face the 4-2-1 burden. One child supporting 2 parents and 4 grandparents. That weight reduces savings, limits consumption, and crushes optimism. Growth built on a young, cheap workforce can't survive in an aging nation. Beijing has tried to respond. It's rolled out massive infrastructure projects, subsidies for households, and credit support for struggling banks. In 2025, stimulus equal to nearly 2% of GDP was announced, aimed at stabilizing demand. Officials speak of high-quality growth, pivoting from construction to technology, green energy, and advanced manufacturing. But here's the problem. Every new stimulus adds to the debt pile. Every slogan about innovation clashes with the reality of tighter political control. The reforms that could spark confidence are the very ones the leadership seems unwilling to embrace. To understand the gravity of this moment, look at the idea of peak China. For years, people believed China would keep rising until it overtook the United States as the world's dominant power. But now some analysts argue that peak has already passed. Its share of global GDP is falling, productivity growth has slowed, and structural weaknesses are harder to hide. The comparison that many are making is with Japan in the 90s. Back then, Japan was predicted to surpass America too. Instead, it entered decades of stagnation. The fear is that China is now standing on that same threshold. What does this look like for everyday life in China? It looks like young graduates sending out hundreds of job applications and hearing nothing back. Families delaying weddings or children because they can't afford housing. Middle-aged workers losing savings as their investment apartments lose value. Small businesses cutting staff or closing their doors. And elderly parents worrying whether pensions will cover their medical bills. The grand story of GDP growth hides these struggles. But for ordinary people, this is the reality. And when confidence breaks at the household level, no statistic can repair it quickly. So is China's economy falling apart? Yes, not in a dramatic overnight collapse, but through a slow and grinding erosion. Real estate has stalled. Debt is suffocating local governments. Consumers aren't spending. Factories are losing orders. Banks are straining. Demographics are shrinking. And politics is tightening. Together, these aren't temporary setbacks. They're structural flaws that no quick stimulus can solve. China isn't disappearing, but its era of unstoppable rise may be over. The question now is whether it can adapt, or whether the Chinese miracle becomes the Chinese slowdown. If this breakdown gave you a new perspective, hit like, subscribe, and share your thoughts. Is China headed for reform, stagnation, or collapse? Let's talk about it in the comments. Thanks for watching, and I'll see you in the next one.